Diageo, LSE, DGE, a global leader in beverage alcohol, is experiencing a significant downturn in its share price, reaching levels not seen in over a decade. This decline is attributed to changing consumption patterns, particularly among Generation Z, who are showing a marked preference for alcohol moderation. The economic pressures of the cost of living crisis further exacerbate this trend, as Gen Z faces tighter budgets, making social drinking less affordable. This generational shift raises questions about the long-term growth prospects for traditional alcohol companies like Diageo, as they navigate an evolving market landscape. In response to these challenges, Diageo is focusing on product innovation and premiumization, aligning with Gen Z's preference for drinking better, not more. The company is investing in ready-to-drink, RTD spirits, which have gained popularity among younger consumers, potentially reshaping the market dynamics for alcoholic beverages. Despite the current downturn, some analysts, including Andrew Mackey, see potential value in Diageo's stock, noting its strong brand power and international reach. With a price-to-earnings ratio of 13, the stock may be undervalued, prompting investors to reconsider its long-term potential amidst these societal shifts.
QuantumScape Corporation, NYSE, QS, a company specializing in solid-state battery technology for electric vehicles, EVs, saw its stock rise by 16% in early trading before settling at a 3.2% increase. This surge follows the announcement of a new production agreement with Murata Manufacturing, a prominent electronics components maker. This partnership aims to facilitate the high-volume production of QuantumScape's ceramic separators, a critical component of their solid-state lithium metal batteries. The collaboration with Murata, known for its expertise in ceramics, is viewed as a significant step toward the commercialization of QuantumScape's innovative battery technology. The recent developments, including a prior partnership with Corning, have contributed to a doubling of QuantumScape's stock over the past month. Investors are optimistic about the potential of solid-state batteries to revolutionize the EV market by offering safer, faster charging, and more efficient solutions, potentially alleviating range anxiety for consumers. However, while these advancements are promising, QuantumScape remains a speculative investment, with its future success heavily dependent on the successful commercialization of its technology. Despite the excitement, QuantumScape was not included in the Motley Fool's list of top 10 recommended stocks, indicating that while it holds potential, there are other investment opportunities that may offer more reliable returns.
ONEOK Inc., NYSE, OKE, has successfully completed a $3 billion public offering, with the proceeds earmarked for addressing its outstanding commercial paper obligations and senior notes due in September 2025. This financial maneuver has garnered mixed reactions from analysts, with Bank of America adjusting its price target for ONEOK from $109 to $100 while maintaining a buy rating. Despite a slight monthly stock performance decline of 1.33%, financial commentator Jim Cramer has endorsed the stock as a recession-proof investment, highlighting the company's leadership and operational strength. The substantial public offering underscores ONEOK's strategic focus on maintaining financial flexibility and stability amid market uncertainties. Founded in 1906, ONEOK is a prominent player in North American energy infrastructure, managing a vast network of pipelines and assets for natural gas liquids, refined products, and crude oil. With 44 hedge funds holding stakes in the company, institutional interest remains robust, reflecting confidence in ONEOK's long-term growth potential. However, as the market continues to evolve, some investors might seek higher returns in burgeoning sectors like AI, which are perceived to offer greater upside potential.
Flowers Foods, Inc., NYSE FLO, a leading U.S. producer of packaged bakery food products, faced significant challenges in the third quarter of 2025, as highlighted in Palm Valley Capital Fund's recent investor letter. The company's stock saw a one-month return of minus 10.89% and a 43.74% decline over the past year, closing at $12.77 per share, with a market capitalization of $2.691 billion as of October 7, 2025. The decline is attributed to the pressures in the branded bread category, where rising living costs have driven middle to lower income consumers toward more affordable private label options. Additionally, the shift in consumer preferences toward health and wellness has softened demand in the traditional bread market. In response to these challenges, Flowers Foods is pivoting its strategy by innovating and expanding into higher growth, better for you segments, such as organic breads and snacks, through recent brand acquisitions like Simple Mills. Despite current operational pressures, the company anticipates stabilizing its core branded bread volumes and achieving normalized profit margins by 2026. Flowers Foods, trading at 13 times the estimated 2025 earnings per share, EPS, continues to generate substantial cash flow and maintain its market-leading position despite being out of favor with some investors. The company remains a staple in 32 hedge fund portfolios, reflecting cautious optimism about its long-term potential amidst the evolving consumer landscape.
The S&P 500 and Nasdaq Composite have achieved a notable milestone by maintaining their positions above the 50-day moving average for 111 consecutive sessions, a feat not seen since 2011. This technical indicator, often used by traders to assess the market's momentum and health, suggests a sustained bullish trend. The last time both indices maintained such a streak, it ended in March 2011, with the S&P 500 and Nasdaq holding for 130 and 129 days, respectively. This current streak underscores the resilience of the market, especially following the recovery from the tariff-induced downturn in April. The prolonged stability of these indices reflects a broader market confidence, as evidenced by the S&P 500's lack of significant volatility, not moving more than 1% since August 22. This stability can influence investor sentiment positively, potentially encouraging more investment inflows and supporting higher valuations. However, market participants remain cautious, aware that such extended periods of calm can precede increased volatility. As traders and analysts monitor these trends, the continuation of this streak will be pivotal in assessing the market's direction and resilience in the face of potential economic or geopolitical challenges.
Realty Income Corporation, NYSE, a prominent real estate investment trust, REIT, favored by market commentator Jim Cramer, has announced the issuance of $800 million in senior notes. The issuance consists of two tranches, 3.950% notes due in 2029 and 4.500% notes due in 2033. This move is part of Realty Income's strategy to leverage its strong market position and favorable interest rates to secure long-term financing. The company's decision to issue these notes comes on the heels of reporting a 5.3% increase in revenue for Q2 2025, reaching $1.41 billion, slightly surpassing analyst expectations. The issuance has been met with a modest positive market response, with Realty Income stock experiencing a slight 0.13% increase in weekly performance. This development underscores investor confidence in the company's robust income-generating potential, as evidenced by the backing of 27 hedge funds. Known for its reliable monthly dividend payments, Realty Income's diversified portfolio of over 15,000 single-tenant commercial properties positions it as a steadfast player in the REIT sector. Despite the positive outlook, some analysts suggest exploring AI stocks for potentially higher returns, reflecting the ongoing interest in technology-driven investments.
Rockwell Automation, Inc., NYSE, ROC, recently saw a reduction in holdings by Kidder Stephen W., which sold 4,175 shares, decreasing its stake by 14.2% during the second quarter. Despite this sale, Rockwell remains a significant part of Kidder Stephen W.'s portfolio, accounting for 2.5% of its total holdings. The transaction reflects broader institutional activity, as several major investment firms, including Goldman Sachs and Charles Schwab, have adjusted their positions in Rockwell Automation. The company's stock performance remains robust, with a market capitalization of $38.69 billion and a price-to-earnings ratio of 40.39, signaling strong investor confidence. In recent developments, Rockwell Automation has received favorable analyst ratings, with Bank of America upgrading the stock to a buy and raising its target price to $410. This optimism is supported by Rockwell's solid financial results, including a reported quarterly revenue of $2.14 billion, surpassing analyst expectations. The company's strategic focus on industrial automation and digital transformation solutions continues to drive growth, as evidenced by a 4.5% increase in quarterly revenue year over year. With a diverse global presence and a strong product portfolio, Rockwell Automation is well positioned to capitalize on the increasing demand for automation solutions across industries.
Bear Mountain Capital Inc. has marginally increased its stake in the Vanguard Short-Term Corporate Bond ETF, VCSH, now holding 256,434 shares valued at approximately $20.3 million. This ETF, which focuses on investment-grade corporate bonds with maturities ranging from 1 to 5 years, represents 7.3% of Bear Mountain's portfolio, marking it as the firm's sixth largest holding. The move is part of a broader trend among institutional investors, with firms like Sequoia Financial Advisors and Vista Chima Wealth Management also significantly boosting their investments in VCSH in recent quarters. Vanguard Short-Term Corporate Bond ETF, trading around $79.78, offers a dividend yield of 4.4%, making it an attractive option for investors seeking stable income amid market volatility. The ETF's performance, with a 12-month range between $77.58 and $80.14, reflects its low-risk profile, appealing to those looking for steady returns in a fluctuating interest rate environment. As more investors shift towards fixed income securities, VCSH's popularity underscores a broader market trend favoring stability and predictable income streams.
During the second quarter, both NBT Bank NA NY and Arcator Capital Management LLC reduced their holdings in the Schwab International Equity ETF, NYSEARCA, SCHF, with NBT Bank decreasing its shares by 2.7% to 212,059 shares valued at approximately $4.69 million, and Arcator reducing its stake by 3.9% to 127,583 shares valued at about $2.82 million. Despite these reductions, the ETF remains a significant component of their portfolios, indicating ongoing interest in its international equity exposure. The Schwab International Equity ETF, part of the Schwab Strategic Trust, has a market capitalization of $52.18 billion, a price-to-earnings ratio of 16.14, and a beta of 0.87, suggesting moderate volatility relative to the broader market. The ETF has demonstrated strong price performance, with a recent opening price of $23.56, a 50-day moving average of $22.87, and a 200-day moving average of $21.66. Over the past year, its stock price has ranged from a low of $17.56 to a high of $23.84. The adjustments in holdings by NBT Bank and Arcator reflect strategic portfolio rebalancing, typical of institutional investors responding to market conditions. Simultaneously, other institutional investors such as UMB Bank N.A., Hexagon Capital Partners LLC and Week Capital Management have increased their positions, illustrating a broader trend towards international diversification. This collective activity underscores the ETF's appeal as a stable investment option with balanced risk for those seeking exposure to international markets.
Chevron Corporation, NYSE, CVX, has experienced mixed activity among institutional investors during the second quarter, with Broderick Bryan C. reducing its stake by 8% and Henley & Company, Inc. trimming its position by 0.9%, now holding shares valued at $7.71 million. This trend reflects a broader pattern of varied investor sentiment in the oil and gas sector, where institutional investors collectively own 72.42% of Chevron stock. Despite these adjustments, Chevron stock has demonstrated resilience, opening at $154.92 and maintaining a market capitalization of $267.70 billion. The company reported a quarterly earnings per share, EPS, of $1.77, surpassing analyst expectations of $1.58, despite a 12.4% year-over-year decline in revenue to $44.82 billion. Analysts have given Chevron a consensus hold rating, with an average price target of $165.15, indicating a cautious yet balanced outlook. The company's dividend yield of 4.4%, supported by a recent quarterly dividend of $1.71 per share, continues to attract income-focused investors. Insider trading activities have included significant sales by Director John B. Hess, who sold 375,000 shares worth approximately $59.36 million, and Vice President Alana K. Knowles, who sold 3,978 shares. These transactions have not substantially affected the low insider ownership, which stands at 0.20%. As Chevron navigates a complex landscape of fluctuating oil prices and evolving energy policies, its strategic decisions in both upstream and downstream operations will be closely watched by investors and analysts.